Hi everyone, welcome to the NOAA Central Library. We're very happy to have Brigitte Roth Tran here with us today from the Federal Reserve Board. She's an economist, I'm going to stumble over that, economist, where she performs academic research examining how weather and natural disasters affect various economic and financial outcomes. She received her PhD in economics from the UC San Diego, where she focused on environmental economics and was a National Science Foundation Eigert Fellow at Scripps Institution of Oceanography. Please help me welcome Brigitte.
Thank you so much. I'll be presenting today a project called The Price of Extreme Weather Uncertainty, Evidence from Hurricanes. This is joint work with Matthias Krittli, who's also at the Federal Reserve Board, and Sumudu Watugala, who is at Cornell University. Before I launch into it, I'm going to give the disclaimer. Many of you may be familiar with this concept, that the analysis and conclusions set forth are those of the authors, me and my authors, and they don't represent the views of the Board of Governors of the Federal Reserve System or the researchers at the Federal Reserve System. So, launching right in, what is the question that we're seeking to address in this work? Basically, our focus is on asking what are the implications of uncertainty due to extreme weather for financial markets. And in particular, we focus on hurricanes in this project, and I'll talk in a minute about why we chose hurricanes. And there are two key sources of uncertainty that we look at in this project. The first one is landfall uncertainty, which is basically the meteorological physical uncertainty about the location, timing, and severity of a weather event. And in the case of hurricanes, it's about where the hurricane will make landfall, whether it will even be considered a hurricane at landfall, when it will make landfall, or if it will go out into the ocean and dissipate. The second form of uncertainty is impact uncertainty. So once we know what a hurricane has done in terms of the wind speed and the rain that it brought and the storm surge, all of these physical aspects of it, there's uncertainty remains about what the impact of that hurricane will be on individuals, businesses, and communities. And we call that impact uncertainty. So in terms of why we are interested in answering this question, our motivation for this project, there are several key points. The first is that extreme weather events like hurricanes are expected to become more frequent and severe under climate change. This is not my area of expertise, but I know that this is going to become an increasingly important question to understand the impact of extreme weather events. The financial cost of extreme weather and uncertainty is a potentially important cost of climate change that hasn't received a lot of attention yet. When there is uncertainty that affects firm profitability, financial investors in financial markets end up having to spend money trying to deal with that uncertainty. And so it's a potential cost that should be factored in when policymakers are trying to make decisions around what actions to take with regard to climate change. Finally, appropriate pricing of uncertainty reduces the risks of severe market correction and provides better incentives for managers. If the markets are paying attention to the risks and pricing them in, then there is less of a likelihood that they will be caught completely off guard and we will have to suffer a major correction in the markets. Similarly, if managers know that financial markets are going to price in this kind of uncertainty, they will have incentives to try to increase the resilience of their organizations to extreme weather events because they don't want to take the hit for uncertainty from extreme weather more than they have to. So I mentioned that there are some reasons why we chose to examine hurricanes for this project. The first one is that we feel that with hurricanes we're able to identify a pretty clear start and end. Now there are multiple starting points that we could choose from, but we're able to identify particular points of time when certain events happen. In the case of this project, at this point in time, to be conservative, we're treating inception as the point in time when there's at least a 1% chance of hurricane force winds on land somewhere in the United States, the Atlantic coast. We could choose other points for inception, like when a tropical depression is named, for example, but we can have a very clear starting point to the event. And like I said, we've chosen our inception point to be conservative because the choice that we made would limit our ability to find effects because we're taking the starting point fairly late in the process. Hurricanes also have a pretty clear end point in time. So we can see when the hurricane has made landfall, and we can then track the events after that point in time. The next reason is that there is a lot of media attention, and this is likely to yield investor attention. We know that hurricanes get discussed a lot, so if investors are paying attention to extreme weather, they're probably paying attention to hurricanes. The next point is that we have access to very helpful historical forecast data, which we were able to process and interpret for this project. And finally, hurricanes, unsurprisingly, tend to have large impact. So if we want to see what the impact of extreme weather is, this is a good starting point. But we hope that our analysis framework can be applied to other types of extreme weather events. There is quite a bit of literature that this paper relies on, and I won't be going into detail on it, but I just want to point out some papers in a few key strands of literature. The first is that hurricanes have been shown to have large economic impacts, whether looking at incomes, at population movement, at employment. There's a variety of work out there showing that, yes, unsurprisingly, hurricanes have a big impact. There's also literature that shows that people and firms respond to weather and climate forecasts. This first paper is a recent one by Andrew Martinez that shows that damages are smaller when the hurricane forecasts are more accurate. That paper uses the path and the predicted point of landfall, as well as some other variables. Jeff Schrader has a paper looking at endocycle forecasts and shows that in fisheries there are responses to those forecasts. And then there is some literature in housing that shows that sea level rise forecasts may have some impact. There's not quite a consensus there yet. And finally, there's a significant literature on financial markets and how they price in uncertainty. This is the first work that we know of that looks at extreme weather in this context, but other strands of literature have looked at economic policy and the uncertainty it introduces, and uncertainty from elections. And we use a lot of the methodology from these papers and this literature and this work. So I'm going to give you a quick preview of results. First of all, we find that financial markets price in significant impact uncertainty due to hurricanes after landfall. So after landfall, uncertainty continues to be important in financial markets. Next, we find that the stocks of firms that were exposed to hurricane damages that are located in areas that experienced hurricane damages have negatively skewed underperformance in the months following hurricanes. And what that means is that, and I'll show you a picture later, but it's not that the average firm is doing worse, it's that the underperformers are doing much worse than the underperformers in the control group. Financial markets also react to landfall uncertainty before hurricanes make landfall or dissipate. We will have data, we include data here on events where the hurricane ends up dissipating and not making landfall. And finally, one more, we don't find evidence that markets do a better job of forecasting than NOAA, which I think is probably good news here. Finally, we also look at over and under forecasting, and we find that it does yield significant changes in implied volatilities, and that improvements in forecasts, which we have seen a lot of in recent years, have yielded investor savings. So here's the outline of the rest of my talk. I'm going to briefly cover the sources of data that we use. And then I'll talk about our general empirical strategy. And finally, I'm going to discuss the results. I'm going to separately talk about impact uncertainty results and landfall uncertainty results. And then I'll talk about some extensions. And I'll talk more about the empirical strategies of each of these components as I go through them. So in terms of the data, we've combined quite a few sets of data here, and I'll talk about each of these in turn. First, we combined option metrics and CRISP CompuStat data on daily options and stock prices, and for the options implied volatilities as well, which I'll describe in a moment. We used NETS data on firm establishment locations to estimate the proportional exposure of firms to hurricane risk. We used FEMA data on disaster declarations and where they gave aid. And we used SHELDAS data, which builds on NOAA data, to look at where the damages occurred from each of the hurricanes. And finally, we used NOAA forecast data on wind speed probabilities to estimate the daily county level hurricane risk. So first of all, the financial outcomes. So we used crisp CompuStat data for stock price data for publicly traded firms. And this is pretty straightforward. You use this closing stock price on each day to calculate the returns. Then we use something called implied volatility from option metrics. So for those who need a refresher or maybe aren't familiar with options, think about a stock. If you think that a stock is overvalued, you might want to go short on a stock or sell the stock and then plan to buy it back later at a lower price. If you think a stock is undervalued, then you'd buy it now because you expect the value to go up. If you think that the stock is fairly valued, but you think that there might be a change in the price that could be dramatic, for example, you might choose instead to buy a stock option. And that stock option allows you in the future to buy or sell the stock at a particular price. And what that lets you do is hedge your risk, that's the term. It allows you to protect yourself in case there are big swings in the prices. And the prices of those options allow us to see what the perceived uncertainty is in the market. And that is measured by something called implied volatility, which is used as a proxy for uncertainty in financial markets. So we're going to be using options. For those of you who are more familiar with them, we're going to be using slightly out of the money options that are more liquid. And we're going to be averaging over the implied volatilities of all of the options for each firm on the nearest to maturity expiration date. But basically, the idea here is that in addition to stocks, there is the market of options, which investors use to manage risk around the price. And we can deduce from that implied volatilities, which tell us what the perceived uncertainty is that investors are willing to pay for in the financial markets. We also have NETS establishment data. What you can see here is the distribution of locations of firms in that data set around the country. The colors reflect the deciles of the firm establishments per county. We have on the order of 5,000 firms in this data set. It includes private and public firms. And one thing that you can see here is that the areas that tend to be most affected by hurricanes do have significant business activity in them. So we're going to have a good amount of power here because there are a lot of establishments. We also have data on where sales are located, and the results are pretty similar to what I'll be showing today. But I'll be showing data based on where firms have their establishments. So if you're talking about Starbucks headquarters would be an establishment, but so would each of its store locations. The next data source that we use is data on damages, and we combine data from FEMA, and in particular, we include individual and household program declarations, which is IHP. This is where FEMA is giving aid to individuals who have been affected by disasters. And we also include data from SHELDAS, which is a data set that estimates the damages at the county level for each of these events. And we used the official public criterion for the minimum level of per capita damages per county that would qualify for the individual and household program aid. And here's an example of Hurricane Sandy, where you can see in the dark blue, the FEMA aid was given to individuals and households, but then in the lighter shaded light blue color, those were also counties where in the SHELDAS data, which is based on NOAA data, the damages were considered significant enough to meet this threshold. We have run our analyses for damages both looking just at FEMA data and this combined data set, and they seem to be robust. Finally, our data set on NOAA forecasts. What we do, and I'll show an example in a moment, is we look at, for this project, text files of 5-day forecasts for wind speeds in advance of hurricanes. And there are particular locations listed in those forecasts. This map here shows you the counties for which locations exist in this data set with forecasts for tropical storm or hurricane force winds. What you can see here is that there are a lot of counties that never show up, not because they never experience these kinds of winds, but because not every single point is supposed to be included there. So these are some of the key places. Here's an example of the kind of text file that we used to estimate hurricane risk up front. What you can see is that the columns go through 5 days, from 12 hours ahead to 120 hours ahead. And each of the rows is for a location. And if you look at the second column with the knots, you can see that we have 34 knots is the minimum threshold. But if you look toward the bottom, you can see that we also see wind speed probabilities for 50 knots and for 64 knots, where 64 knots is the minimum wind speed to be qualified as a hurricane. So what we will be using these sorts of files to capture the wind speed probabilities at particular locations. However, as you saw in the previous slide, we don't have the wind speeds at every county. So what we have to do is interpolate. And what we have done, here's an example of Hurricane Sandy in the dark brown, which is a little hard to see on the left panel, but there's probably just one county there that's darker brown or darker red. Those are the locations that would have been included in that text file with wind speed forecasts above some threshold. And so what we have done is we've taken a series of potential probability thresholds. For example, in this map we show locations for which there was at least a 10% probability of 64 knot winds over the next 5 days in that location, according to those text files. And what you can see is that we've interpolated. In the lighter shading, these would be the counties around that. So basically, what we have done is created a set of indicators. A county is at risk if the probability exceeds our threshold of, say, 10%, 1%, 20%, 40%. We have different thresholds that we look at. So a county will be considered at risk if it exceeds that threshold over the next 5 days. And then we interpolate within a given radius. And the radius that we've settled on is a 75-mile radius. So any counties whose centers are within 75 miles of a county that was shown to be at risk according to the wind speed forecasts will also be considered at risk. There's going to be some measurement error here, but that would bias our results toward non-results, and we have found that this seems to work pretty well. So empirical strategy. What we do is for hurricane, we calculate the hurricane damage exposure for each firm. A firm would be firm I, and for a particular hurricane. And the way that we do that is we look to see how much of the firm's establishments, what share of that firm's establishments are in each county. For example, it might be 5% of its establishments in a given county. And then we interact that with an indicator, the second term here, the I sub C, for whether that county was in one of the counties that experienced damages during that hurricane. So then we add that all up and we see what share of each company's establishments were in counties that experienced damages from a hurricane severe enough to get FEMA aid or to meet that threshold and shell this data. So this is a continuous variable ranging from 0 to 1 for each firm. We do the same thing for forecast exposure. Using the county indicators and the interpolated counties that I showed for the wind speed forecasts, and we do this at a variety of different thresholds. We look at what share of the firm's establishments are in a county, and then was that county within the risk area by that threshold and that definition. And then we see how much of the firm's establishments, what share, were at risk at a given point in time. And here on the very right end of the equation, you'll see that we have a subscript, T sub H, that's for that hurricane, minus gamma. And gamma is the number of days before landfall. So for one hurricane, we can look at different points in time. And the landfall can also be dissipation here. Okay, so I'm going to go now to our results for impact uncertainty. Remember, impact uncertainty is when you already know the hurricane has hit, we know exactly what it looked like, or we're capable of knowing that potentially, but we don't know how it will actually impact individuals, firms, and communities. So the way that we look at this is we look at the effects on implied volatility. If you recall, this is our measure. This is how we proxy uncertainty in the financial markets. And what we look at is the log in the change, the difference of the implied volatilities. And on the left-hand side, you'll see that we look at the implied volatilities for Hurricane H tau days afterwards. So we look at it a particular number of days after landfall, and we look at it relative to the last trading day before inception. And what we're going to do is take the variable that we created of the hurricane damage exposure, how much of each firm was exposed to the damages, and we're going to control for each individual hurricane with a hurricane fixed effect, the theta sub H. And we're also going to control for industries, because we want to make sure that we're not driving our results by particular industries, and we include an industry fixed effect. And when you look at this, the main conclusion to draw here is that if investors have expectations of impact uncertainty post-landfall, if they're concerned about that, our lambda here is going to be greater than 0, because the implied volatility will go up. So looking at some results here, these are the days after landfall relative to before inception. And what you can see here is 95% confidence interval bands in the light blue, but we find that impact uncertainty is having an effect. Volatility, implied volatility does go up significantly in the 5 days after a hurricane. So there continues to be uncertainty about what will happen to particular stocks. Now, we wanted to see, well, how does this relate to stock returns afterwards? If there's uncertainty, then maybe we see something in the stock returns. But we didn't necessarily think that we would see something in the average stock returns, because the markets, if they're concerned about some average effect, they should price that in very quickly. Otherwise, you could make a lot of money off of that. And so what we wanted to see was if there was some sort of skewed effect here. The way that we do that is for each firm and each hurricane, we estimate an abnormal return using the Fama-French 3-factor model. This is a standard model for estimating abnormal returns in the finance literature. And basically what it lets you do is say, okay, if we use the standard variables to predict what the returns would be, that's going to be the variables in the parentheses on the right. We subtract that off from the actual return, we're left with an abnormal return. It's like a residual. And we're going to aggregate that to a cumulative abnormal return over time. So we take that for each day and add those things up, and we get R sub I, AC. This is the cumulative return, abnormal return from the day of landfall to some number of days afterward. So we want to see if there's an effect afterwards, if the markets weren't able to sort out what the effect should be right away. We compute the differences between firms that had at least 50% of their establishments in the counties that had damages, and we compare the outcomes for those firms to the control firms that had no locations in the counties that had damages. And we estimate the standard errors using a bootstrap that's clustered on the firm headquarter counties. When we do this, we see in the first 5 days after landfall that there is not a significant effect. There's not a significant difference. Not only is the mean not significant, but there isn't any distributional difference either. But what we saw was that at this same point in time, 0 to 5 days, there is an implied volatility effect. So uncertainty effect is higher. So when we looked further out at 0 to 120 days, look 4 months out, we do see a significant effect. And in particular, what you can see here is that these are the quantiles. So the lowest 10% of the performers in the treatment relative to the control performed about 12% under their control group. So we see that there's a significant underperformance at the lower end. And this makes sense that the implied volatility is anticipating, markets are anticipating that there are going to be some real losers here. And that's what we find in this result. The bottom 20% is closer to 20th percentile is closer to 10% underperformance up to 4 months later. So the next thing that we look at is landfall uncertainty. So we can see that after a hurricane makes landfall, there is impact uncertainty. The markets, it takes them a while to figure out who is really going to lose out because of the hurricane. But what about beforehand? How much are markets responding to hurricanes before they actually make landfall? And one thing to keep in mind here is that impact, as landfall uncertainty decreases, as you're more certain that a hurricane will or will not make landfall and where it will happen and when it will happen, the impact uncertainty, if the hurricane will make landfall, the impact uncertainty goes up. So to some extent, landfall uncertainty is uncertainty about whether there will be impact uncertainty. So we basically use the same methodology that we used before. We look at the difference in the implied volatility, the uncertainty priced in by the market, and we look at this now as a function of the forecast exposure, and we look at it in the gamma days before dissipation or landfall of a hurricane. Again, we control for the hurricane and for the industry. And here, and again, investor expectations of impact uncertainty after landfall will imply a significant positive lambda. So what we find is that if we look just 1 day before landfall dissipation, that implied volatility goes up significantly. And what you can see along the x-axis is we have included different thresholds for the hurricane force winds to designate a county as being at risk. So even if there's just 1% chance of a county having hurricane force winds over the next 5 days, we can see that 1 day before the landfall, that there is an extra cost, implied volatility goes up for those firms. And if there's a 50% or greater chance, it goes up even more. We don't have enough statistical power to go much higher than that, but we can see that there's a significant relationship here. And what I'm going to do in the next slides is just go through the days. And we can see, if we look at 2 days before, there's still a significant effect, but 1% is no longer statistically significant. 3 days before, 10 and 20% are still significant. 4 days before, still significant at 10%. So the markets are pricing in this uncertainty 4 days before landfall, and at 5 days before landfall, we lose our significance. But this could be partly due to power, statistical power, because there aren't as many observations that fall into this category. Now we look at stock returns and the forecasted hurricane path. And what we're going to look at here is comparing, looking at the stock return, so the difference between the stock price, gamma days before dissipation or landfall, relative to the price before inception. And again, we use this forecast exposure variable that we had earlier. Again, we're controlling for hurricane fixed effects, and we're controlling for industry fixed effects. Now, investor concerns about this landfall uncertainty would imply that our lambda would be negative. In other words, if investors are paying attention, the stock price will take a hit very quickly, and it will take a hit before the hurricane makes landfall. What we can see is 1 day before landfall, relative to before inception, that we see significant stock price effects. So the markets are paying attention, and the stock prices are coming down 1 day beforehand. With at least, and we're able to measure that with statistical significance with at least 10% probability of hurricane force winds. And what you can see here, if you look at the very right-hand side, is that we have an 8% effect for the firms that have the greatest exposure. So in other words, before we had a 12% effect for stocks after landfall, at the lower end, the stocks that were the worst off saw a 12% reduction in their a 12% negative returns in the 4 months after a hurricane. And what we're seeing here is 8% negative returns in the period before the hurricane. So that's 20% if we add the two up, negative returns for these stocks. Again, 2 days before landfall, we still see an effect. 3 days before landfall, we still see an effect. 4 days, now we don't see the significance. We saw the significance on implied volatility, but not on the stocks. And 5 days before landfall, we also don't. I'm going a little faster than I expected here, but so we are at the extensions at this point. And the main point, one of the main analyses that we did as an extension was to ask whether the market can forecast better than NOAA. So one of the ideas here is that there's a famous paper by Roth back in the day where he saw that markets were able to price in weather effects in orange juice futures, I think it was. And the idea here is that if there is money to be made by beating NOAA, there's probably some hedge fund there that's trading based on some forecast that they can do, and we would see the effects before the NOAA forecast shows the effects. Now, there are some potential issues here because of measurement error. Our forecasting, the way that we've captured the risk is incomplete. We haven't captured rainfall, for example, but we wanted to see if we could see the market beating NOAA forecasts as we've measured them. And in particular, what we do here is we look at under prediction. And under prediction, we define that as the difference between the actual hurricane exposure and the forecast exposure if the actual exceeds the forecast. So if we think about a company and imagine that 20% of its establishments were in counties that ended up having serious damages from a hurricane. But when we looked at the forecast, we saw that only 15% of the company's establishments were in counties that seemed to be at risk. There's a 5% difference there, and we would consider that under prediction. If instead we had found that 25% of the establishments were in the forecasted areas, that would be an over prediction. The difference would still be 5%, but we would count that as 0 here. And so what we wanted to see was if we include this under prediction, so if we add in the additional counties that did not have predictions, and that value will change depending on which threshold we use percentage-wise for the forecast exposure. We had the 1%, the 10%, 20%. That will change for the firms. But we wanted to see if we could get some prediction out of that by adding that in along with the forecast exposure that we have. And so the idea is that if the market seems to be responding to the actual exposure up front, in addition to the forecast exposure, then that would give us some evidence that somebody out there maybe is trading and beating the NOAA forecast. When we did this, we regressed the implied volatility on the forecast exposure with our under prediction measure. We did this 1 to 5 days before landfall and dissipation, and we found no significance on those coefficients. And so basically we don't find any evidence that the market is beating the NOAA forecasts. There are caveats that, it could be a question of power and measurement error, but we still find significance on the forecast exposure itself. So I'm going to conclude here and just make a few more points in my conclusion here. Again, we find that the financial markets are pricing in significant impact uncertainty due to hurricanes after landfall. So after landfall, implied volatilities go up. Investors are still paying to manage that uncertainty. They're not able to figure out which firms are going to be the most affected. When we look at the stocks of the exposed firms, we see that there's this negative skew. On average, the stocks of affected firms don't underperform the control, but when we look at the bottom end of that distribution, we see that they are significantly underperforming, and by a lot. And this means that the uncertainty is anticipating, this is consistent with the uncertainty, the implied volatility, anticipating that there are going to be these serious losers. Financial markets also react to landfall uncertainty before hurricanes make landfall or dissipate. We've done additional analyses where we can see that where we look at daily levels in a different way, and we've done some robustness checks, and we find that this continues to hold. Financial markets are paying attention. They're spending money on managing that risk, and it is a significant factor. We don't find evidence that markets forecast better than NOAA. And finally, while I didn't show the results here today, we have done some preliminary analyses looking at not just under prediction, under forecasting, but also over prediction to see how much the firms are over and under predicted. And what we find is that depending on the measure, we can get anywhere from hundreds to thousands if we're looking at a really extreme measure of over and under predicted firms. And when we multiply that by the coefficients that we've estimated, we see that the implied volatilities could change by 100 to 200 basis points. We're still refining this part of the analysis, but it does imply that the improvements that we have seen so far have yielded investor savings, because to the extent that that uncertainty can be reduced, investors don't have to spend as much managing it. However, even if NOAA forecasts were perfect and they got everything right, there still we'd still see that impact uncertainty component. And that tells us that to the extent that firms can respond better and develop their resilience, we might be able to reduce that uncertainty there as well. And with that, I'm going to conclude my presentation and turn it over to questions. Thank you.
Thanks so much, Brigitte. Does anyone have any questions in the room?
So I've got many, but some of them are probably best after. But the landfall uncertainty I find fascinating, but the fact that it includes location, timing, severity. You looked at wind probability threshold. There are a lot of physical variables here. So I work in the Office of Weather and Air Quality, and I'm one of their social scientists in that program. And one of the things that we're wondering is, is there a particular area of weather research we should invest in a little bit more to reduce that type of uncertainty? You've kind of put them all together. So does your research show that, is there any one particular variable that we could tease out that if we reduced that uncertainty, we would have a more positive effect on the outcome?
Okay, so I understand because of the webinar, I need to repeat the question, and I need to repeat it to make sure I got the question too. My understanding is that you're saying that we've combined severity with geographic breadth, with timing, all of these elements of uncertainty into one measure, and that in your office you're trying to understand which of those components of uncertainty would be most helpful to reduce. I'm afraid that I don't have the answer to that at this point, because we have lumped it together, but that's something interesting to think about. I'd have to think about how to model it. In current work that I'm doing with a colleague, Brian Soak, who's here, we are looking at a different form of the forecast where we're using the models to the spatial output that look more like what people are used to seeing on the maps. And maybe we'll be able to tease that better out with that kind of data, but I'd be happy to talk more about that offline. Sorry, I don't have a better answer.
Any other question in the room?
This is kind of a follow-up to that question. Just thinking about aggregate uncertainty, it seems like it would be a fairly straightforward extension point to value investments in reducing uncertainty forecasts. Is that something you talk about?
It is something so the question was that it seems like it would be a natural extension to value the investments in reducing uncertainty in the aggregate. It is something we've thought about, and so that's where the last extension, which is a work in progress, trying to figure out the difference in implied volatility could come into play, but then we'd have to translate, okay, what does that implied volatility mean in terms of dollars? And so it's a work in progress, and we're trying to figure out the best way to model that. I will say, even though this isn't my work, that Andrew Martinez's paper that I mentioned, he looks at the aggregate damages and how those are affected. If you're interested in that, I recommend looking at that paper as well.
Any other question in the room? Let's switch over to the online. Sorry, let's switch over here. Questions. Did you also look at the impact on the real economy and actual prices, such as how stock prices impact the actual economy via changes in interest rates and consumer producer choices?
So we did not look at that. I'm in other work with my colleague who's in the room here, Brian Stoke. We're looking at housing market responses and we're looking at forecasts and in housing markets. So I am trying to do that. One of the things that's really nice about the forecast data is that we have it at higher time intervals, higher frequency, but a lot of those outcomes are not higher frequency. I do have other work that's looking at monthly and quarterly levels of the impacts of natural disasters on those kinds of outcomes, but it's not going to be at the daily level, and so we can't see how employment is responding to hurricane forecasts, for example, because we don't have daily level data there.
Do longer lead times for hurricane forecasting, more discussion in advance of landfall, increase or decrease the monetary effect on the market pricing of uncertainty?
That is a great question. We haven't looked at that specifically. We've thought about looking at measures of salience through, for example, Google Trends to see if people are paying more attention earlier on. We haven't incorporated that at this point. We do, one of the things to keep in mind is that we have, there aren't as many observations when you're looking, say, 5 days beforehand relative to later, but the fact that you see, to the extent that we see responses a few days beforehand, the additional responses after that would be smaller. I'm not sure I'm answering that question, but that's, yeah,
That's
my best attempt.
Do we have any more questions in the room?
Just a follow-on to that. My brain is spinning.
Yeah.
On the one hand, our science may allow us, so right now, the arrival of tropical storm force winds, well, that's arrival time. So the tropical storm force probabilities start as soon as we have a hurricane form or even a depression. So it's available theoretically for days. I mean, if it forms 2 weeks out, we would have those probabilities for days. So I know you only looked within a 5-day span. Is it because there were no effects prior to 5 days? Or because I guess the question that I can't articulate very well is, with some of our products, we could go further out in days or times. But I guess I'm concerned now that even though we can, should we? In other words, if we're using the measure of volatility as a negative effect, which I'm not so sure it is, I want to make sure I've got an assumption that it is good or bad here. Because if it's bad, then we ought to perhaps be careful about how many days out our product should be. Maybe, on the other hand, for life-saving purposes, we want to make sure they're out as early as possible. So again, I'm not sure I've articulated a very good question. But I guess I'm looking for the effects on time and the perception of whether this volatility is good or bad. We'll start with that.
Okay, so I'm going to do my best again to repeat the question. I think there were 2 parts. One is this implied volatility effect a good thing or a bad thing? As in, should we be trying to reduce it or avoid it? And 2, tied to that, is if we think about being able to extend the forecast, say go beyond 5 days because the models allow us to do that, should we be doing that? What would be the impact of that? Would it, life-saving is one thing, but what effect would it have on stock prices? I'm not sure I'm able to answer that with the data. We have thought about, I've spent a lot of time looking at pictures of hurricane paths and tracks, and with my eye, in my mind, I just kind of imagine it continuing straight on from where it's going. You know, that I kind of extrapolate mentally, and I think that probably some people are doing that. And to the extent that that's happening, we are not capturing that in our data right now, and so we could potentially maybe see effects sooner if people are doing that. But one of the reasons we don't go further earlier is because we start to lose power. We need to have enough firms that have enough exposure. So if you go really far back, you know, in the line graphs, we lost the number, we lost the categories on the right because they're just, you're not going to be forecasting necessarily 50% probability in enough counties that enough firms have enough exposure, publicly traded firms, enough exposure that we would be able to measure the effect. So I'm not sure we're able to do that with the current data to say what that would look like. In terms of implied volatilities being a good or a bad thing, I think that investors pricing things in sooner rather than later is probably a good thing. And so implied volatilities indicating that there's concern sooner rather than later is probably a good thing. But implied volatility could go up a lot if you are now putting out forecasts that have a lot more error in them. So if you were to put out, say, a 10-day forecast, and there's just so much uncertainty, people don't know what to do, you could end up having investors spending a lot of money trying to manage this uncertainty in a costly way that is not helpful in the end because the probabilities were just too low. I would hope, though, that because you have probabilities in those forecasts, the probabilities would probably be pretty small if there is a lot of uncertainty, and our results suggest that the markets wouldn't react as much if the uncertainties are really low, so maybe there wouldn't be a cost. Again, I don't have a clear answer. It's very interesting.
No, that was fascinating.
Okay. Yeah.
Are you going to give your presentation at the National Hurricane Center?
I don't have any plans as of yet.
I've
not been invited. I'd be happy to if they were interested. Yeah.
I'm gonna grab a few more online. Do you find more significant impact on price volatility for the petroleum refinery sector? That is, if a Category 4 or 5 hurricane was projected to hit the Gulf Coast, would you see more significant impact?
We have not. I think that I'm trying to remember because we've done so many variations at this point. I don't have an answer to that specifically. It would be interesting to explore. One thing that we've talked about doing, because we do have the industry fixed effect, so our hope is that with that we're not simply seeing that, because if you have a hurricane going toward that part of the country, it would be such a broad effect on the whole industry potentially that we wouldn't actually see that effect in there because the whole industry would be affected by it. So we're pretty confident that our results aren't being primarily driven by that. We don't have a huge amount of power to look at a lot of heterogeneity in the responses, but there is some potential to follow up on that more, and we'd be happy to.
Okay, we have one more question that is building on the longer lead time with forecasting. So how might the recent rapid intensification of past hurricanes like Michael or extreme damage from low category storms Harvey and Sandy affect economic uncertainty impacts in the future?
How might the recent rapid intensification affect economic uncertainty? I mean, I think that I could imagine there being increased uncertainty about the impacts in the future. I could imagine there being increased attention, which could drive up the implied volatilities if investors are more concerned about it. But beyond that, we haven't interacted our variables with the time trend, which is what we might do to look at that. I'm not sure that we would have the power statistically at this point to do that very well. But it is a concern to us. As I said at the beginning, part of our motivation is that we are concerned that hurricanes will become more severe and more frequent. I will say that one of the things is that I also understand that hurricanes are not just a function of the wind speed, that the water is a huge issue, the rainfall and the flooding, and that's something that future work could look at as well. Any other questions? Or I see a question in the back here.
I'm thinking about two different types of hurricanes. One that is pretty well forecast, so you have pretty small area, pretty high probabilities. And you have another hurricane, not, more uncertain, say the larger area, lower probability. You showed that there's like that residual net decrease of the total stock price due to these uncertainties. Would you say that do those prices ever bounce back? I guess is the question. I'm thinking about if you're, it's like kind of Brigitte question, if you're kind of trying to go farther out and saying, yeah, there's some small probabilities of some damage to these areas, and the stock price is going to just go down a little bit because of the uncertainty. Does it ever come back to say, actually, no, the hurricane never hit there and ended up going somewhere else, and so then it's going to come back up? I'm just, I think again the difference between a relatively poor forecast storm.
So let me try to repeat the question back again. So you're interested in the difference between a well forecast storm and a poorly forecast storm, where the former we would have really high probabilities and in a very narrow area potentially, without this big spread around it, and in the latter we would see very low probabilities. We're not sure where it's going to hit, and then you're wondering if we see differences in the stock prices, if they bounce back for the areas that were not hit. Yeah, so we haven't looked specifically at the asymmetry potentially in responses to movements. So one of the things is that we do have data on counties where there was a forecast risk and then it ended up not having damages. And we also have data where there was a forecast for a possible hurricane and the hurricane dissipated or just went somewhere else. You think about Hurricane Sandy, for a while they thought it would hit much further south. We have an alternative specification where we look at daily differences in a different manner that shows that it suggests that those movements are significant in and of themselves. What we have not done is looked at what happens to the prices specifically when the change is negative. So we have looked at what happens to prices as the change in risk, in response to the change in risk from one day to the next, but we haven't separately looked at that response if it's positive versus if it's negative. And I think you're interested in that to see, do we see a significant response when the uncertainty goes down? And that's something we can do.
We have a few more questions online.
Okay.
One is, what economic sectors are most sensitive to gains, losses of volatility from your findings?
It's a great question. We haven't looked at heterogeneity in sectors or industries. We're controlling for them at this point. I mean, I think that one thing I will mention is that we have excluded financial sector stocks that are probably just funds. So we're not including those, but I could imagine that some financial or insurance firms would be particularly sensitive. I would imagine that petroleum sector could be particularly sensitive, but we don't have specific results on that.
Okay, thank you. And we have one fairly longer question about the Saffir-Simpson scale. So does your model shed any light on whether markets rely solely on the Saffir-Simpson scale prediction, or do they account for different information?
Our model does not currently look at that because we do use just the wind speed probabilities, and we are using this cutoff. Furthermore, we're not using data on what category of a hurricane is. Instead, we're using how widespread it is. So we're not able to see the difference between, say, a category 1 is just barely a hurricane in terms of the winds, and with it versus another storm that has the same exact footprint, same exact probabilities, but is much stronger. However, I think that the stronger a hurricane is, the more likely we will see those higher probabilities of those hurricane force winds sooner. That's my understanding. So there is some differentiation there, but we're not currently looking at that. There's so much potential data to use, and one of the tricky things that we had to deal with in this project was actually how to simplify it, how to get something that we could work with that was tractable. And so we definitely made some trade-offs, and there's a lot that we left out, but we saw that there was already a significant response just to doing that.
Any more questions in the audience? I'm gonna grab one more online. How do you factor in the fact that markets are not wholly efficient?
I mean, I think that that's part of what we're seeing here. We are seeing that the markets are not wholly efficient in the sense that they're not able to see everything right away, and that it takes a while for them to understand what's going on. So we're not assuming that they are efficient or that they are inefficient. We're just trying to see how they are responding. I think to some extent we're a little bit agnostic on that, but we're also seeing that they are responding, but it takes them a while to figure out what's going on.
I think we're going to stop it there. Thank you so much, Brigitte, for answering all those questions, and thank you for coming.
And thank you so much for hosting me.